I recently had the great pleasure of catching up with Devin Ryan, head of financial technology research at Citizens, for our second deep dive conversation. Since the last time we spoke, the stakes of fintech have only grown. We've gotten back into the weeds on stocks like SoFi, Coinbase, Circle, and also dug into a potential new favorite of his, eToro. But with over 20 years of Wall Street experience, Devin has cultivated a fantastic track record of calling bold price targets rather than just simply following trend. I'm incredibly grateful to Devin and his team for their time, for joining me once again, but please enjoy the conversation with one of the best in the business, Devin Ryan. Ladies and gentlemen, the great and powerful Devin Ryan. Devin, thanks for joining me again.
Good to be back here, Tanner. Thanks for having me.
What do you think about 2026 for these fintech names that you cover so very well?
So I think that's a loaded question. There's probably a lot to answer because there's so much going on in the space right now, and even today with the potential credit card cap, which I'm sure we'll come to. But I'd say taking a step back, 2025 was generally a good year for my coverage, meaning most of the fintech firms did a couple things. One, they brought in a lot of new members, which is very important to kind of the long-term trajectory of growth. And then they also were very aggressively executing on their product roadmaps. And so now we're exiting 2025 into 2026 with, I think, a lot more legs to the stool for virtually all of at least the leading companies that we're focused on. And then the other, I think, key piece in terms of what we're looking at and what's helped some of these stocks is the profitability profile. So in addition to growth and diversification of the product platform, they've also been very focused on expenses and not starving growth, but really just trying to drive some of that growth or incremental growth to the bottom line. And so that's a really good formula for investors. And so some good performance in 2025. Not everybody participated, which we can talk about, but ultimately we're heading into 2026 with, I think, a lot of momentum. And then, I think still a lot to pay attention to just across the macro front, but also company-specific front as well. There's so many interesting themes around whether it's tokenization with stable coins or if interest rates move lower, mortgage adoption for firms like SoFi or Robinhood or Wealthfront, which just came public in December. So the bottom line is, a lot of business momentum. I think the unit economics of these business models are really starting to come through. So you're starting to realize that these firms have advantages over incumbents, and so that accelerates the flywheel. But yeah, I think a lot of momentum, and you're happy to go any direction you want here in terms of companies.
Yeah, no, that's a great way to start it. So first off, you put a market perform on SoFi Stock. Obviously, I cover this name a lot, and I'm so happy that you've initiated coverage on this name because it gives me a lot of additional insight into this name from a institutional perspective. But market perform versus outperform, what do you like about SoFi, and what would get us to the next level from your view to think that this is potentially one of the better names to hold or look towards for 2026?
Yeah, so it's been a phenomenal growth story, and I give them a ton of credit for what they built. So, I think in the lead in here talking about adding more members and diversifying, like they're, I'd say, at the top of that list or one of the top several in that bucket. And I think when you look at what they're doing, they're still scratching the surface in terms of the addressable markets that they're going after. And I think they have a right to win in a lot of the areas they're going after. So, the short answer is I feel really good about the business positioning and what they're building in terms of a diverse model that meets their customers across the board. And also, I think increasingly high frequent engagement, which is important. Like when you're doing a student loan, you connect with that customer at the time of the loan and then you service it, but it's not really like a product that customers are excited about. They're just getting their maybe it's a better experience than the alternative and in theory a better rate, but that's not a frequent engagement. And I think what SoFi is doing so well is finding new areas to engage with customers more frequently. And those areas are going to be obviously in banking, so day-to-day banking transactions, but I think increasingly doing more and investing in the brokerage side of their business. I think the whole concept of integrating AI into the experience of customers being able to optimize their financial lives. And SoFi, we talk about right to win, like they've got all the products and now they're layering technology in to deliver them in a better way. And I think that's important. And then you think about like crypto and digital assets, which I'm excited about as an analyst. I've been more bullish than most on this space. And I come from 20 years of being kind of an old financial service analyst covering banks and investment banks. And I think I'm one of a small number of equity research analysts on the sell side that has been bullish on crypto, because I see is the convergence of the technology with the old world financial system and the ability to upgrade it. And so SoFi is sitting in the middle of that, where they've got the legacy, you got the bank charter, they got the regulatory know-how and the infrastructure. Then they also understand the technology layer. And so the ability to bring blockchain from kind of the speculative shadows pilot phase, we like to call it, into 2026, which is the beginning of mass adoption phase, when it's not just about trading meme coins, but about how is blockchain being used as a transaction layer to move money, to make payments, to trade on with tokenized securities. That to me is exciting. And I think SoFi will play a role in a lot of that, particularly the money movement. And then over time, more about tokenizing assets, tokenizing loans and things of that nature. So that's a whole new value stream that I see them playing a role in, which is, again, kind of more frequent engagement than kind of the legacy firm. And then in terms of this platform business being kind of still early days, but you see the potential in how fast it's scaling and how material it's already becoming, and yet it's still they're originating at a fraction of the the volumes that they get demand for in terms of where customers are coming to them looking for a loan. So I see all these growth vectors. So it's a long lead in to kind of give you our position on the stock. So yeah. I recognize that this company is building something, I think, potentially very big in a massive addressable market, tens of trillions of dollars of assets when you look at all the different pools that they're going after. And you talk about unit economics, like they have a very low cost delivery system that's very scalable. So therefore they can provide a lot of value to their end customers, yet they can still do it profitably. And then when you layer on other products, it only accelerates that. I guess when we initiated coverage earlier in the year, the stock was $12, $13. And my view was, this is absolutely mispriced relative to where we see what I just laid out for you around kind of the future of the company. And then it went to well over $20. And that's when we brought our rating to a market perform. That doesn't mean go short the stock or that we're negative on it, but we said, the stock just doubled. Let's take a breather here and let their financials catch up a little bit to, in our view, the intermediate term opportunity. And that's kind of the window we're in right now, where and where I'm going is, it's about risk and reward for me. It's not just about let's make a pie in the sky bull case scenario and say, if we just did that, the stock price should be dramatically higher because there's so much tailwind here. But I'm also looking at it as I'm recommending it to my institutional clients. Like, if I'm wrong, or let's just say we're all wrong and there's a recession, and what happens in that scenario? I think that in that scenario, for a short period of time, they'd have to really curtail their lending. The loan platform business would slow because the demand wouldn't be there for a short period of time. And so you could have essentially a pullback in revenues for a short period of time on a path of what is clearly leveraging the unit economic advantage and the customer acquisition advantage that they have. So that's like the long-term story. But we're saying in the intermediate term, in our valuation construct, it's a bit more balanced. And really that's all it is. So if you're talking to somebody, my clients that are institutions, even the ones that are like, quote unquote, longer term oriented, they still are trying to manage month to month, quarter to quarter. And so we, sometimes have to look at like, what is the downside risk if things roll over in the macro backdrop versus what do you get if you're right? And so at $12, the skew was dramatically to the upside with very little downside because it's all priced in there. In the mid 20s, I still think there's a really good long-term story. And if you have patience, you can do really, really well if everything plays out that I just articulated. But that's kind of the balance that I'm trying to think that through for my clients that are trying to navigate, like, where are things substantially mispriced relative to maybe even the near-term scenario, and that's just where we kind of, so let's take a little bit of a breather. There's so much more. I mean, as I mentioned, like the macro backdrop getting better, mortgages. SoFi never really participated in a mortgage, real mortgage boom. Now they've got a really good product where they're going to be very competitive on pricing. And I think that's going to be important both for driving new revenues directly from mortgages, but also as a customer acquisition tool, but also a relationship lending tool. So that's where having all of the different products in the product suite that customers would want, very important. You can say, we'll give you a mortgage and we'll give you 50 basis points below the national average, but we need you to consolidate X amount of dollars here to do that. So like you're going to see potential step functions in asset gathering off of mortgages to the extent we get into a more interesting mortgage market, which we haven't been in. So I really like the story. I think a lot of the perceived risks, the slowdown, I think the perception of the accounting around lending, that you need to always be growing or you kind of get in trouble. In some theory, that is accurate, but I think that people are unfairly characterizing the model and not also appreciating the long-term profile. Now the company also has $3 billion of incremental capital, which happy to talk about, that they didn't have heading into last year. And that provides substantial, interesting optionality too. And I think if you were to say, Devin, what will it take to maybe have another buy on the stock again in the near term? It would be things like that there's something that happens from an optionality perspective that's not baked into my base case, but they've got some money sitting on the sidelines that could do something really interesting with. And then the last piece here, and I think this applies to all of these companies and why the sell side often gets it wrong and the buy side sometimes gets it wrong too if they're not as far in the weeds, is that innovation is very hard to model. And so it generally doesn't get credit. Like Robinhood right now, we're given a fair amount of credit for innovation because we're seeing how fast they're shipping products and how those products are now delivering on their financials. But like 2 years ago, I was making the same argument on Robinhood, and I know we'll probably get there. But my vision was what Robinhood's doing today, but nobody was willing to pay for it because they're just looking at it like, hey, this is just a commoditized broker, not understanding that this company's going to be incredibly innovative, technology forward, and leverage unit economic advantages. So anyways, that's how we're thinking about SoFi. Really good story. Expect a good quarter. And then I think what's going to be important this quarter is how they guide. So I would not be surprised to see them raise the bar on particularly, remember when they gave the 2026 guidance back in early 2024? And at the time, it was like, how the heck can they get to 55 to 80 cents? Those are big numbers. And here we are. And it's like, I think they're going to get easily into that range in 2026. But I think what they may do is maybe they put out another, not aspirational target, but another big headline number to get people anchored to for 2 years out. If they're confident in where earnings are going, then I think they may be confident to, whether, and we wrote this in a report that we put out today, but maybe it's $1 of EPS that is like the next goalpost here for them to try to meet. So that's how we're thinking about it. But really good story. It was a little bit of a valuation again, we're thinking about the upside case, bullish, but also a little bit of risk if the economy rolls over. Probably a little bit more risk there than some others, and we're just putting that all together. And so it's a matter of what's your time frame, and can you live through a little bit of macro volatility if we get to that environment? And some of my clients have a harder time doing that, so we're trying to kind of frame the whole upside and downside for them, and that's how we get to. We're in a little bit more of a balanced view, but recognizing all the execution here and that they're taking share, but they're still teeny tiny in massive addressable markets.
You also stated in your article quite a lot about the push into more capital light revenue streams. Do you think that would also lead to them getting a bigger premium? Because for me, like let's talk about this risk as well, the 10% credit card cap. So if you could address the capital light concern, and then the credit card cap, how do you think that affects SoFi? And is that one of the risks that potentially, people have been worried about?
So bingo. So I think it's when you're a balance sheet driven firm, people don't sleep as well at night around all economic scenarios, right? Mm-hmm. And inevitably we feel good yesterday, but then you walk in today and you're like, what is this noise around? So it's those are things that can change the game. And so that's exactly it. That going towards more capital light businesses really kind of lets people sleep better at night. And also, importantly, all that earnings power that gets generated then becomes, a lot of it becomes excess. So rather than having to plow, if you want to grow, plow earnings back into the business to grow it, right? So like balance sheet firms, they generate earnings, but if you want to grow your balance sheet, you got to put some of that capital back into it to support that growth. So all that capital as a shareholder doesn't get back to you, it stays within the firm. So that impacts the valuation. If the company becomes more capital light over time, that means more capital to go out and do M&A or buy back stock or just return it to shareholders. So that's valuation enhancing. But absolutely, I mean, that's the direction they've articulated that they want to go. And it's absolutely, in my mind, they've got advantages in lending, and that's, having the bank charter. And so you don't want to exit that. But I do think that from a valuation perspective, if the loan platform business, even though it's still making loans, it's not using their own capital, that's valuation enhancing. The more that grows, and that's still very adjacent to what they're already doing. But then if they can really ramp up what they're doing on the brokerage side and on the digital asset side that are not as capital intense, that to me is very interesting. And that's where, as you talk about, you've got $3 billion of capital now in the firm. In theory, they could use some of that to go buy student loans from the government if that happens, and maybe that has something to do with it. Or they could take that money and go buy companies that are going to accelerate their path towards more capital light revenue streams. And that's kind of what I don't know they're going to do that, but I wouldn't be surprised to see them do some interesting stuff on the M&A front with this capital that's been brought in. And my guess would be more capital light than capital heavy. And so that's, I think, part one. And then Happy, you want me to go into this?
Yeah, I would love to. This hit everyone like, I mean, he had originally talked about the 10% credit card cap Trump for his one of the campaign promises. However, it kind of went away a little bit. Now we have a deadline, January 20th. I saw you tweeting about this online, but what do you expect, especially for a name like SoFi? Like, I know they don't have a big credit card business, but does this affect the debt consolidation on their personal loans?
Yeah. So there's so much in here, and it's such an interesting conversation. I know people are all over the map on what this means, what's going to happen, how to play the stocks. And so, as we do always, it's like you have this stuff happen, or we're trying to, what does the world look like in an environment where there is a 10% cap on APR, and who benefits, who does not, and what does that world look like? And so I think the first point is forget all the good stuff, because if you're capping credit card APRs at 10%, the average right now is 20%. There's $1.2 trillion of credit card debt. So essentially you're saying that if you're a credit card firm, you're essentially going to go from, in general, the revenues just from the revolving piece are well over $200 billion today, and you're cutting that to $100 billion. And you expect that that's not going to have an impact on the credit card company's willingness to provide credit. As you're putting a price control on credit, of course, and there's so much history, and I'm happy to kind of go there with other examples over the last 5 decades of state by state essentially denying capping rates, and then ultimately subprime back in the 60s and 70s, subprime lending dried up because there was restrictions on what lenders could charge. Even go back to the Card Act, which was 2009, where it wasn't around the rate, but that significantly reduced. And there's Fed data on this, the amount of accounts that people got their accounts closed. And so ultimately, what would happen at a 10% rate is most of the credit card firms, especially for the customer cohort that is riskier, would lose their access to credit. And so in that scenario, the market doesn't just reprice that immediately, and SoFi or others come in and say, we're going to take all that. What happens is the U.S. economy is 70% consumer-led. And so around the edges, that's going to create massive uncertainty into the market backdrop and into the economic backdrop. And so in that scenario, that's probably the fastest way to get us to a recession, in my opinion, would be to actually do this, because you're essentially going to restrict some portion of that $1.2 trillion I just mentioned from having buying power. buying power. And so ultimately, that's going to slow down the economy quickly. In that environment, lenders don't step in to be an alternative. They get out of the way because investors aren't going to give you credit. If you're the fastest growing bank or lender rushing into a recession, the market will crush your stock, not reward you for putting more loans into the market. And by the way, spreads are blowing out in that scenario. So you don't want, you wait for the dust to settle. You see where spreads come to. So that means you don't on day one go out and make a bunch of new loans. You let the spreads blow out, let the dust settle, and then you can come in and fill some of that void. And I think that's ultimately, if you were to say for SoFi, is there an opportunity, or some of these other firms, buy now, pay later firms? In theory, I think there is.
But it doesn't matter.
First order of magnitude is like the world's going to look really bad. And by the way, it's not just for credit card lenders or personal finance lenders. Spreads across all of credit will be affected because if consumer spending is slowing down, commercial real estate is going to get hit. Every other loan category is going to get hit, and spreads are going to blow out ahead of it. So what today tells me is that the market's not pricing that in. The market's up right now, and so the market, I think, is saying not we're scared of a 10% cap. Maybe there's a little bit of that, but I can tell you what some of my client calls have been today with some of these large institutional investors. It's not so much, hey, Devin, like this is terrible for this company because I can't believe they're going to be at 10%, but it's how do I invest now into a world where you've got President Trump with the push of a button now creating headline risk for every company that's in this bucket. So anything that deals with high APR is getting hit pretty good today.
Yeah. Not
because the markets decide we're going down to 10%, but because now you're in the zone of the president's focus, and that's not a good place to be. And so, and I'll tell you why I don't think the market's saying this is likely, because if the market believed this was happening across the board, every other aspect of the market would be down because it's all connected. We would be rushing towards a recession if all this credit's getting taken out of the system, which effectively capping at 10% would force companies to cut off a lot of their customers. So that's how I'm looking at it. But like, you can't dismiss it because you're now in the crosshairs. The flip side is, that might create opportunities for stocks that are getting unfairly beaten up. You get a little bit more valuation when the reality is their business model changing today versus yesterday? No. So these are, when I look at it, like you kind of want to understand what is the path of travel here and how long will this take to play out? And it feels very much like a election element here. So maybe this is, affordability into the midterms and saying, hey, we're on the side of the end, of the U.S. consumer versus, these big bad companies. And like, that's a strategy, business strategy, right? An election strategy, but ultimately, where does that lead us? And there might be, like, what I don't know is, are there other aspects here? Like, is this just the negotiation? So we're not going to 10%, but maybe this is an avenue to be able to get late fees down or do other things that are more workable than just forcing the industry to cut their rates. I mean, it's just, there's no law here that I know of that would force that. I don't think the company is going to run towards this. And so, but does that mean they won't give some concession? I think that's possible as well.
Well, like in your report, I really like, or maybe it was in your tweet where you talked about, hopefully there's some path to educating people on the fact that there are refinancing options and potentially that is a benefit to some of the names that we're talking about. But just to touch on your point of potentially not being in the crosshairs of the administration, I completely agree with you. In fact, I like to invest where the administration is, benefiting those areas. And one of those areas I actually think is crypto. There's been probably the most crypto forward administration that we've ever seen pretty early on, but still. Coinbase is not a name that I hold. I've been a little bit on the sidelines with this name, but you have been very positive on this name, and I need to understand why.
Yeah. So when I take a step back and look at the landscape, crypto, up until we're at the starting line of my call, but up until now, it's been all about how much money can I make getting into this industry as an investor before institutions come and let somebody else buy this, or maybe I'm having fun investing in like meme tokens, but like, how serious is that really in terms of like a technology? But like, that's all that really existed, because the industry was not allowed to exist in the form of what the technology can do. And so why I'm bullish is that I believe that as a technology, the infrastructure of blockchain is powerful. And you're seeing it because every large financial institution wants to now engage in it because they're getting the green light. And firms like BlackRock, Larry Fink, and Rob Goldstein, if you haven't read it, read the Economist article from probably a month ago, where they talked about you're wanting to tokenize like all their assets and bring everything on chain. So you've got the largest, and that's one example, and I can give you 20 more of the largest asset managers saying, hey, there's a lot of value to us to tokenize all of our assets, and T+0, everything's a big deal. If you're a brokerage or an exchange, there's a lot of interest in adding more assets to be able to be traded. So if you can, today we trade stocks and bonds, but if you're tokenizing real estate across the street from me here, or IP rights, or like, now you're creating a whole new world of interesting investable assets. And so it'd be great to be an exchange that can provide liquidity hub to transact in them. But really, we're going from pilot phase of crypto to actually the beginning of using the technology for mass adoption. And mass adoption doesn't mean we're all speculating on meme coins, but it means that you own a tokenized stock, Tanner, and it's Robinhood, but you don't care that it's a tokenized stock. You just know you own Robinhood, and when you sell it, you get it. You can take that money instantaneously and send it, that cash, to a friend in Brazil, and there's no settlement time. And by the way, there's for the back end firms on the plumbing side, for firms like Robinhood, there's no cost. They have to put up money with the clearinghouses, where, if you remember back 5-6 years ago, where they got in trouble, if you will, because of all the meme trading, they didn't have enough capital on hand to pay the clearing firm. So it changes the whole construct of how money moves and how assets move. So I think that the technology itself is going to be a very big deal. And we are now going from pilot phase to mass adoption. And this is where it's like now becomes serious. And so Coinbase is interesting, because a lot of people look at Coinbase like, oh, it's an exchange and they trade and their fees are high. And that to me is like very, very like 30,000 foot, you're missing the boat. And by the way, when they got into being an exchange, that was very value add, because up until that time, before Coinbase came around, it was very hard to buy and sell crypto, and it was very easy to lose it. And so you need a trusted counterparty in a place where there's liquidity, and Coinbase provided that. And for that, they could charge a pretty healthy fee, right? And so that was the business model up until today. But I'd say this has been evolving and changing over the last 4 or 5 years. In 2020, 2021, they really started to build out some of these additional capabilities. So staking and custody, and now USDC having their own stablecoin in partnership with Circle, another publicly traded company. The way I think about Coinbase is they are the picks and shovels of mass adoption of crypto. So if my thesis is right, that a lot of new companies, whether it's banks, institutions, asset managers, merchants, business to business, using stablecoins to move money for lower cost, Coinbase will be in the middle of a lot of that growth. Mm-hmm. And so they've essentially created the infrastructure to play in all the different lanes that digital assets get adopted and blockchain gets pushed into the real economy. And this isn't a technology where a bunch of banks just come in and say, we're going to do that and you guys are out of the way. It is very technical. There's not a lot of experts that are out there that you can just go hire 5 people and then all of a sudden have a digital asset strategy. So Coinbase becomes a necessary partner to a lot of firms that don't have, maybe JP Morgan can get there on their own, but everything in between is going to need a partner of choice to help them. And Coinbase has a full menu of products and services. And historically, the only thing people cared about was trading. But going forward, they're going to care about, how do I move money on these across blockchains, on across countries, and convert it back from one currency to another currency. Coinbase is going to do all that. Coinbase is, you hear the message, the everything exchange. Mm-hmm. So as we bring more assets on chain, they understand the technical aspects of how blockchain works to trade these assets. So the whole incumbent financial system is coming towards them, of these exchanges that want to get into crypto. Coinbase is sitting here that fully understands how the technology works and is saying we can set it up where we're the liquidity hub and can transact in all these different assets and understand the security and the liquidity aspects of it and the digital wallets. And so we'll do that, and you can come direct to us, or we'll white label it for you as an institution, even a bank, and you can have your own offering for your customer base, but we'll get some spread in that. And so when we launched on the company 5 years ago, the message was like, it's a little bit cliche, but this is the Amazon AWS of crypto, because they built all the capabilities and they were primarily using it in-house, but now they can offer all those capabilities up to outside parties that need to get into the space to be able to offer blockchain. And if you don't, then you kind of have your head in the sand. And so that's like in thesis in a nutshell. And there's a question of like, let's map out the revenue streams. And like, because they're going after something that's so big, this is not going to be on a straight line. So it is going to be a volatile stock. And I think there's going to be a lot of people that misunderstand it. And it's just like everything. That's where you get alpha. You have to understand the time horizon. Like I think it's going to be volatile. Like the next couple of years are really, that's the game theory of like, who's going to be the winners here? How does this all map out? What are the new revenue streams that are coming in? But I do think that Coinbase has such a head start and they understand this stuff so intimately that gives them a big advantage. And now they're connecting all these other products and services on. So now they're already doing traditional banking services, but on crypto rails. They're doing now they're getting into stocks, right? They're sort of getting into all these other asset classes, prediction markets that are all going to be incremental to the story in 2026. At the same time, this like mass adoption theme is literally just getting going. It didn't exist until now, but now we have this regulatory green light. Chair Atkins, the head of the SEC, is a 180 differential from the prior SEC regime, and so he's very constructive around bringing assets on chain. So you've got a very favorable regulator. And then the last piece is, do we get legislation? Legislation, the Clarity Act may be getting gunked up here a little bit. But I do think that we'll eventually get legislation, but legislation is just important. It's not necessary, but what it does is it just stamps the space where the next administration couldn't come in and completely derail all the progress. So it's more about just solidifying in lawmaking a lot of the rules that are already getting taken care of by the regulators that are starting to open up the space.
I completely agree with you on everything that you've said so far. And I think crypto's taking over. It's hard to ignore what Jamie Dimon and Larry Fink and all these guys are saying. But I think Coinbase owns something like 85%, at least of the initial, ETH and Bitcoin ETFs. They custody all those, and they make no money. Like so my concern is just, although they're getting into all of these avenues, a large percentage of where they make their money is still on comparatively very high trading trading fees to retail customers, and companies like Robinhood or SoFi will bring them down on that. Yeah.
So so a couple of things. One, on the spreads, because I think that's an important point. It's like, hey, their spreads are high on trading. What people don't understand, I've covered market structure firms for 2 decades, and there's a very easy knee-jerk reaction of like, hey, spreads are high, they must come down. The reality is that if you want to trade at Coinbase for low spreads, you can, and they offer that. So you give the best pricing to the people where it matters the most. And so their institutional investors are paying 3 basis points to 6 basis points.
Yeah.
Retail investors, if they're trying to do something, and they don't trade very often, but they're trying to convert ETH to another token and then stake that token, that's kind of a complicated thing that you probably want to be on a place that you trust that experience, and that you can maybe do some other things with your other assets that are on that. So you're like, I'm not doing this every day, so I'll pay 2% to do this one time, and I'm doing it 5 times a year. And so ultimately, that's where that customer, the price is not their first thing. It's what is the experience, and ultimately everybody else is somewhere in between. And so that's the pricing construct you have to think about. Like Robinhood's going the same way. Robinhood actually went backwards. They went from the lowest price in digital assets, and then they kept climbing. So like no one cares. It's not changing behavior to charge them more because people trust us. And so But Robinhood's then now gone to a tiered system for their trading, where if you're trading a lot, you get better pricing than somebody that's not trading a lot. And that makes sense, right, intuitively. So I'd say that's one piece. Like over time, no doubt spreads will come down. And that will be something for Coinbase to deal with. But at the same time as that's happening, volumes will go up. So if you go back 40 years, Charles Schwab, which was a discount broker 40 years ago, it was over $100 to trade a stock for one trade. Now to trade a stock on Schwab, $0. Do you think Schwab makes more money today or less money? They make many multiples more today at zero commission rate than they did 40 years ago with, by the way, 50% operating margins, because they've diversified the platform and volumes in the market have scaled to such a degree. That's the parallel I think to think about here. I'm not being dismissive of spreads coming down, and like there is some risk there, but I do think that it's not what people have framed it as. That's one point. The other point is to your question. I think that we are at such an early stage of this space developing that we can't really put normal revenue models on it. So meaning there's $300 billion of stablecoin market cap in aggregate in the market right now. I think that's going to be $3 trillion by 2030. At $3 trillion, Coinbase will make a lot of money in these other areas besides trading. In tokenized assets, there's like tens of billions of dollars right now in tokenized assets outside of stablecoins. In theory, there's tens, if not hundreds of trillions of dollars. There's tens of trillions easily over the next decade that will be tokenized from from $10 billion today, 20 billion. And so the point is, like, we are just scratching the surface of how they make money and where they make money. And that's kind of my argument, that we can't apply, like, to an exponential growth curve. It's hard to apply, like, how are they doing? All of a sudden we're going to wake up, and if they won, or one of the winners, I don't think there's other great companies here, by the way, but as that happens, if they can maintain reasonable share in that, this market overall could be 5 to 10x the size that it is today. And that's really, that's why it's not going to be on a straight line, because if you're investing into something that's small but can become really big, to get to really big, it's from small, it's going to be much more volatile when it's small to getting to that addressable market. That's one point. The other thing I forgot to mention that I think is a huge catalyst in the first half of this year for them is I do think that they could potentially launch their own token on Base. So they've got their own blockchain called Base. It's a layer 2 blockchain that sits on Ethereum. And they built it in the prior regulatory regime where there wasn't a lot of clarity around, could you have your own token? Is it a security if you have your own token for your own blockchain? Particularly, Coinbase is already under the regulatory microscope. And they also needed to scale it. So you want to have full control over it. If you look at other chains like Binance, much bigger and it's different, but Binance's tokens like 100 billion plus in value. If Coinbase put a token on Base, where essentially what that means is if you're a token holder, the value of that blockchain's fees and economic stake flows to the token holder, not to the corporate entity Coinbase. And what the relevance of that is that if you took Coinbase's, call it, network and the amount of transactions already happening on Base, and compared that to some of these other blockchains that are out there that have tokens, the equivalent is probably many tens of billions of dollars of incremental market value that you would assign to Coinbase, because they're going to own 100% of it on day one. And then once you have this token, what does that mean? Now you have an incentive structure to get mass adoption on. So you can give JP Morgan or others some of the token for them to build on your own blockchain. And you can give them some of the token so that they can help kind of be a part of the governance structure. And so you bring everybody into the fold to build and accelerate network effects. So the token could be really interesting. And I think that we went from an environment where it wasn't feasible and maybe didn't make a ton of sense to this could realistically happen. And if it does, it's not like Base gets no value within Coinbase, because it's, to your point, like, it's not huge revenues yet, could be in the future, but tokens are valued on the future opportunity of that blockchain. Like, people pay a lot of money for Ethereum's token based on the view that Ethereum's blockchain is going to see a lot of activity on it over the next 5 years.
Right.
So Base would get the same benefit of having their own token, and I think could be just equivalence of it, tens of billions of dollars, which is not baked in to the stock price at all.
What made them change their mind on, I don't know what you call it, Coinbase with Base Coin or something like this, but what What made them change their mind? Because my understanding is, what was SBF's company?
FTX.
FTX.
Yep.
I remember Brian Armstrong came out during that and said that they were not going to do a coin because of the same sort of problems that Sam Bankman-Fried and Binance and all of these companies, that it sort of muddied the waters of transparency or
Yeah.
something along these lines. So
I think there's kind of two things. So one, obviously a different world and how blockchain is evolving, and having a coin versus not a token versus not having a token, what makes you more competitive, as now all these other blockchains are coming out and trying to fight for users and fight for development on top of them. And so you need something to incentivize adoption. And Coinbase has a brand and trust and things that can incentivize adoption. And also, network effects create benefits where others want to use your blockchain versus others. But the other big thing, and I think FTX was maybe some part of it. The other big part of it was there was no regulatory. Coinbase is already getting sued by the SEC, the old regime.
Yeah.
And so if they try to come out and say we're building our own blockchain, that would have been squashed most likely very quickly. So having now this new regime that is effectively, I think the legal view on it right now is that these are not tokens and that this would now be allowable. That's massive calculus in terms of the change for them. And then on top of that, the points I made a minute ago of like, this is getting really competitive. There's all these other blockchains that are going to have their tokens, and they can use some of that token value to bring in partners and incentivize them to use their blockchain. Coinbase, in theory, could be at a little bit of a disadvantage if they don't. So having that token gives them advantages or puts them in the mix, but their network is already scaled. Like their base does a lot of transactions and much more than many other blockchains that have tokens that have value in the market that are $10 to $20 billion, if not more. And so my point is, none of that's really big. Coinbase is trading up and down based on spot trading volumes right now, and you're missing the big picture of like, is this industry going to be a lot bigger in 5 years, and are they going to participate in a lot of that growth? And that's for them. Like where I'll be wrong, in my opinion, is more like, can they maintain their market presence as this develops? But I also don't think that a lot of people even understand that this is a lot more than just a trading exchange. And I think a lot of my institutional clients, when I tell them, hey, they may have a token, it's like, what does that mean? Right. So people aren't as tuned in to even like what this whole space is doing, because it's just very technical and people are getting there. But I think they're still getting up the curve on it.
They recently just did a system update. I'm sure you were all over that, showing off all their new products. You said this beautiful thing in your recent report today. I love this. You got to quote this. Execution matters, as investors will not pay for 5 future businesses unless 2 to 3 are clearly scaling.
Yeah.
I like that a lot. Made me think about Robinhood and why they get such a premium, because everything that they do scales so freaking well. So there's a lot of execution credit that they get.
100%.
As me reading into Coinbase, what are the successfully scaling businesses that I should look into to see what's working?
Yeah.
To believe that they can do the Amex card and the Coinbase Pay and all these things.
Yeah, sure. So I mean, first and foremost, even though we're kind of knocking like it's just a trade, there's still a lot of growth opportunity in trading, because you think about this market is institutionalizing, and what that means is that it's going from just we're whipping around these cryptos. So like institutions need prime brokers, and they need people to custody their assets, and they want access to capital to take on leverage and all these things. And so Coinbase is going to play a role in a lot of that institutionalization. And so there's a lot of revenue streams that are just getting off the ground that I think you can see in small, but I'd focus there a little bit because the market is still going to grow, I think, relatively rapidly. And also the equivalent that I put on it is like, it's like a commodity market where, Ethereum's the commodity, and there's in the oil market, you've got airlines that need oil. And so they're going into the commodity market and buying oil. They may actually hedge out their future risk or buy oil in the futures market. So you've got institutions that are allowing that, and market makers, and providing liquidity. They're providing lending and financing and all those things around it. But then you also have speculators, and you've got derivatives markets that are built around it. You've got a whole market structure. But that's what crypto is moving to this market like commodities, where I see a whole market structure evolving around the tokens. And there doesn't need to be a million tokens. There needs to be a small number that get critical mass, like ETH, like Solana, like pick your ones that are scaling. And there will be other new ones that have interesting, SUI, other interesting elements of why they could win. But it's going to shrink in terms of the relevance. But then to your question, like, what are the businesses? So, I mean, I think first and foremost, look at what they're doing with USDC, and that's scaling to a material revenue stream already for them. And I think we're in the very early innings of what that's going to look like over the next few years. And so, I'd say that's a proof point beyond trading that is scaling very nicely. Then I think that the other ones that are really on the come are more. There's obviously the trading of all these other prediction markets and stocks, and like those are interesting to me. And I mean, Robinhood is so good there that it's like Coinbase is going to take them time to be there. The good news for Coinbase is they have customers they have the majority of their wealth in crypto. And so if you can just add for those crypto native people some additional things they can do, they may stay on Coinbase and continue to do those. Whereas, I think that's the initial push here. And then from there, I think it's really, when we're on the front end of it, is scaling out kind of the payments and the business to business merchant revenue streams. And so that's probably more of you'll see that develop in 2026, but that would be another area that I would focus on as kind of a proof point. But I think stable coins are going to be a big deal and scale nicely this year. Then you're going to start to see some of the more evidence of like tokenizing other assets, and Coinbase's name will likely be involved in a lot of these press releases that are coming out around what interesting things people are doing there.
You touched on USDC. Circle. I don't cover this name enough, and if I was to play in this space, I just feel like I would hold Coinbase regardless. But tell me why an investor might hold Circle directly rather than just Coinbase or something like this.
Yeah. So we were making the argument a few months ago that Coinbase co-founded USDC with Circle back in 2018. So Coinbase is there from the beginning. So it's like, again, they know stable coins, and they have this phenomenal economic arrangement with Circle where any USDC that's held on Coinbase's platform, which is like 20% of the 75 billion that's outstanding in market value, Coinbase gets 100% of the economics off of that. And the economics are primarily tied to reserve income. So when you take $1 of US dollar as a stablecoin issuer, with that, and I give you back $1 of stablecoin, I'm going to take your dollar, and the arrangement is under current, the Genius Act. You have to go out and you have to buy T-bills or some short duration yield instrument. And so as the issuer, you get to keep all that spread. So what Coinbase does, they get 100% of that spread income, even though it's not their own stablecoin, it's Circle's, but if it's on their platform, they get to keep it. Now, what Coinbase is doing is they are passing that yield through to their end customer to accelerate adoption. And that's also something that is a whole other conversation, is getting challenged right now in the Clarity Act, because I think a lot of incumbent firms don't like the fact that Coinbase has this pass through, which in theory could be competitive with bank deposits. And so there's a big kind of pushback. And so there's back and forth there. But our argument was, if you want to buy Circle when Circle is trading at $250 post IPO, go buy Coinbase, because Coinbase actually has as good or better economic relationship on a large portion of USDC. Then on top of that, Coinbase keeps 50% of net economics after distribution sharing with Circle on every other dollar of USDC held outside of Coinbase, except for the, call it 10% that's held directly on Circle's platform. So the point is, Coinbase gets this phenomenal economic relationship without having all the expense attached to it. And they're very incentivized to grow it, though. So Circle, still wants network effects and mass adoption. If I'm looking at today, Circle's share price is significantly derated. And so now if you're bullish on stablecoin adoption, this is kind of your pure play way to play it without some of the other noise that you get in Coinbase. Now, I think that noise in Coinbase is good, but somebody may want more of that pure play. And Circle is building out a payments network. They have their own blockchain called Arc, which is it's in testnet now. But that is something that could be interesting. They have a lot of partnerships and network effects themselves because they were the first mover on stablecoins in the US. But the last piece on Circle as a catalyst is I think it's potentially highly likely that they launch their own token for Arc. And they talked about it on last quarter's earnings call. And that would be when the token value wouldn't be close to the token value of Coinbase. That has much greater network effects, but it would still be a catalyst for the stock. And I think you're going to hear probably an update on that in the next few weeks with earnings. And that could be something that could move the stock even with earnings season.
Do you think that this will be just my last question on ARC, because I do want to get into some of the other names as well. But do you think that ARC and some of these other ones like Tempo, other L1s, have a chance versus Ethereum or Solana, or how do you really see that playing out?
Yeah, so it's a great question. I think that different blockchains are going to be used for different things, and we don't need thousands and thousands to all be layer ones to compete with each other. But Circle is building network effects around payments and around moving money peer to peer and payments, and that will be probably a primary use case where they will also, if they have a token, incentivize people to use their blockchain to do these transactions for a very low cost. But they've got, I think, they've got a pretty big network of partners that are already using USDC, so they could probably find another way to incentivize them into their ecosystem. And maybe some of that is giving them or sharing some of the tokenomics or tokens with those partners, right? So that will help them scale. But the point is that virtually, I see so much activity moving on chain over the next 5 to 10 years that Solana is obviously high throughput, maybe a little bit less secure, but has built network effects and can be used for a lot of different use cases. Ethereum, obviously, layer twos in Ethereum can be used for virtually anything, but on the actual chain itself, Ethereum's a trusted blockchain that's never gone down, that has massive network effects on top of it. So even though the technology isn't it's older, they, I think, have already established themselves as one of the winners. And then I think that you're going to have others like the bases, that are using it for their own transactions. And so it's a question of, can they build up a network of activity? Coinbase in theory uses Base. If they become the everything exchange and all these transactions are settling on a blockchain and then on Ethereum or somewhere else, probably all that runs through Base. So if you go from essentially zero tokenized assets to a world where every dollar of BlackRock is tokenized, and there's $100 trillion of tokenized assets, and a lot of that's trading, and Coinbase is one of the liquidity hubs in that new world, that's going to be a pretty big deal for them. Yeah. So that's what I think those, you have to think through, what are the applications of the different blockchains and why would people use that one? But I do think, it doesn't mean that Solana is a decentralized blockchain that is not associated with at least an organization. And so they may be a preferred place for certain transactions that are away from, you still have, even though Base, as we mentioned, is potentially moving more towards an open open governance, kind of distributed tokens, people may still view it as hey, this is Coinbase's blockchain, so I don't want to really support them. So I want to go to an alternative. And that's in the banking world, if JP Morgan has their own stablecoin, maybe other banks don't want to participate with that because they're giving money to JP Morgan. So maybe we want to have our own white labeled stablecoin through a USDC partnership, right? Yeah, so I think there's a lot of interesting applications here as we get, again, from we're standing at the starting line to this vision of blockchain is integrated in the background of a lot of different types of transactions.
Lastly, I wanted to ask you about eToro. The reason why I wanted to ask you about this is because you had a market outperform on this name, and essentially the entire section of your report was talking about how the market is just not seeing a glaring opportunity, in your opinion. And honestly, I felt like it was your most... Am I free to say that this is one of your top ideas? I mean, that's what you put it as, but you were very confident in this name. And why is that?
Yeah. So I think when we did this last, Tanner, I probably highlighted it. And so you can go back and I've been wrong on the stock. So, obviously you take victory lap if I'm right. But in this case, it has not worked out thus far as we see it. And I don't believe that it's not worked out because the fundamentals have been worse. It's in a lot of cases, you think about the market. And if you go look at our report, this is a big part of the report. A lot of the market is like flows, capital flows, ETF flows, all of that. So like we all want to sit here as like fundamental analysts and say, why do stocks go up and down? And why do stocks get to certain fundamental levels? And a lot of times stocks, you say, here's what the price should be. And then it goes 30% below that. And you're like, how did that happen? And what happened? Liquidity came out of the system and people are forced sellers and they move on. And then stock gets left for dead until the next person has some money in their pocket to come on and buy it. But you look at, like, it's an interesting year, 2025, because my broad coverage of financial services and fintech in general had a pretty good 2025. But there was a lot of money that came in after the election, late 2024, when President Trump won. And then people said, we've been significantly underweight financials and fintech. And now we got to get to equal weight or an overweight. And these are active managers, my institutional clients that I talk to. I mean, I'm talking hundreds and hundreds. Like we talk to hundreds, if not more than that, people on a regular basis that are institutional capital allocators. So we've got a wide spectrum of types of people. But I would say certain people have to be in financials all day long. But then certain people, they allocate across what sectors they think are going to do better. So financials were kind of underweighted by a lot of the generalists that were looking at all the other opportunities to invest. In 2025, active managers rotated in because they said, hey, financials are going to be one of the best sectors that benefit from deregulation and capital relief, cyclical economic recovery. If you think President Trump's going to have pro-business policies, just deregulation overall in the economy, all those things are areas where financials would be net beneficiaries. And so active investors came in and said, hey, these are probably low valuations. We bid them up. Over the course of 2025, then you saw passive money, ETF flows. So there's $30 billion of ETF money that came into financials. A lot of it came in the back half of the year. So ETFs, just passive fund flows, they're not thinking about, is this stock expensive at 30 times? They're just buying because a dollar came in and they have to buy it at whatever price. And unless you have an active manager saying, we're going to sell to you here, you essentially kind of keep raising the bid higher and higher. So a lot of the active managers are like, well, we still think deregulation is going to gain steam and the cyclical recovery is playing out. And so what was already expensive, kind of as the year was progressing, just got more and more expensive as $30 billion of ETF inflows came in. And if you go to the 3 years before 2025, it was net zero inflows for financials. So that tells you way underweight, not interested, to massive flows. So in that world, I'm looking at it saying, Goldman Sachs and Morgan Stanley are great companies and they're going to benefit from all these themes. We know that, but they're so expensive right now relative to what I think the fair value is. But that doesn't matter because if the flows continue from ETFs, they'll just keep pushing the prices higher and higher until it doesn't. And until it doesn't is what I'm concerned about, because then what happens is when the active managers, something changes in the thesis or there's a macro event, the active managers then have to sell. And at the same time, ETFs are selling out of financials. So you get, it's kind of a double whammy on the way down. So I want to be very careful. I don't want to say, hey, that means it's a short in some of these areas, but it means because they could get it more expensive, but recognize they're expensive. The flip side of that is in a lot of small mid-cap financial service companies, even though we're looking at them fundamentally, and I think the further down the ranks you go in market cap, sometimes the more they just get, let's say left for dead, but like there's just less people that are spending all day long, like we are, trying to figure out is this a good or bad company. And so I think for eToro, they came public in the end, I think end of May, beginning of June, and stock ran up to over $80, and then they had first couple quarters were actually okay relative to where numbers were, but it was kind of like, what else do I get here? And also they got the leverage to crypto, and crypto's kind of like volumes dried up, so maybe I don't want that. So you had a lot of people that bought into it initially on the IPO that probably just moved on to go focus on something else. And we've just gotten to this price where there's just not a ton of investor interest. Like I talk to institutions on it, but I'd say it's still rebuilding in terms of area of focus. That being said, when you go back to Robinhood in 2023, Robinhood, for as good of a company as we all know they are today, was effectively left for dead. And Robinhood at that time was trading for just a marginal amount above their net cash value per share. Right now, eToro, on their balance sheet, they've got $1.2 billion of cash, no debt, and the market cap's like $2.7 billion. So you're essentially saying there's very little incremental value in eToro above and beyond the cash sitting on their balance sheet, even though it's a profitable company operating at 40% EBITDA margins. And I think, it's founder-led, just like Robinhood. Yoni, they bought Bitcoin for the balance sheet 10 years ago. They sold it because their board said they should probably sell it, but very innovative. And I think that now they've got a war chest of capital. They've got over $1 billion to go do something with, of which none of that is baked into the valuation. So you're buying the company at 4 times my 2026 EBITDA estimate. And yet there's growth that's coming because they're in, I think, good markets and they're expanding their product breadth, just like Robinhood did a couple years ago. Again, not Robinhood yet, no, and they're competitive to some degree with Robinhood. But then you've got this massive optionality with north of $1 billion of cash on your balance sheet. So when you're buying something for 4 times, this should probably, in a fundamental market, be trading at 15 or 20 times. I think the stock could double, and institutional investors could still say, hey, this is a valuation that makes sense here, and I can still buy some here. So I just think that if I end up being right that the business itself is going to continue to perform reasonably well, and then you've got these catalysts around, particularly the balance sheet, that could get people really interested if they do something. Because if they put some of that cash to work, it'll be accretive, because it's, if you put cash to work that's not generating any return on it, and now that cash goes and buys something that's generating earnings, that'll boost earnings power. So to me, that is the very simple pitch here, that, I have not been right on it up until, went up, looked really right, and then it's kind of come back down. And it's not Robinhood in terms of where they are yet in their journey. But they're competing in slightly different pools. There's the secular tailwinds of outside the US, where eToro has a big presence on the brokerage side. There's a complex regulatory world. And so it's not eToro versus Robinhood. I think about it as eToro versus the incumbents that are not adding a lot of value, plus the secular trend of, just like in the US, more people are looking to invest in waking up. It's like, hey, the capital markets can be good for me in my financial life. And so more people are doing that. And eToro represents a different alternative, or something that's different than Robinhood. So every last dollar won't go to Robinhood. So eToro will get some of that as well.
Really quick, are you seeing similar trends from non-US investors, that they are looking to invest similarly to US investors? Obviously the dollar amounts and everything would differ, but are retail investors coming online similarly to the way that they're doing so in the United States?
Yeah. So it's further behind. So equity ownership is far lower in, depends what jurisdiction, but across different parts of Europe, and then you go in certain areas of Asia and South America, and it's an area where the appetite and the demand is increasing. So the rate of change is very positive, and so we are seeing the same dynamic play. And I actually think that Robinhood pushing more internationally is kind of good for everybody, because it's just it drives the awareness of the value of investing and informational, we're doing this, and other, information is just everywhere now. And so people feel like they're more armed. It's not just for the professionals. It's not just managing your money. You can do it in a positive way, in a self-directed basis. And retail investors have been outperforming institutions over the last handful of years in a lot of places, because they're not getting the drawdown. When markets roll over, institutions are forced sellers, and retail has been, quote unquote, buying the dip. And that's actually worked out pretty well for them. And so I think it's the same theme outside the US as it, there's, every country has a little bit different, different regulators and some nuance around what you can and can't do, but absolutely see the same kind of long-term secular tailwind to investing. And then the firms that win have the same attributes. You've got, it's on a digital backbone, and you're leveraging you're automating things, so you don't have the big infrastructure and the bloat, and so therefore you can pass along more of that value back to the customer. That makes you more attractive than the firm across the street that's got a bunch of branches and people that they have to pay, that eats into what they can give you as an end customer. So, and as you add more products onto it and get more scale, it only accelerates your flywheel, where your profitability profile then can support more dollars of investment to drive earnings power.
Do you have? I'm curious about your timeline. Do you have another meeting, or can I ask you about another name?
I do. Yeah, I do have something here. So I could probably do like 2 more minutes if we want to.
I was just going to ask you very quickly about Wealthfront, but whenever you need to call it.
I think in a nutshell, it's funny. They actually just reported tonight, so I gotta not turn and do my job here, and I get on the earnings call and talk to the management team. But that's one. They just came public again. Similar story, like one of the first robo advisors. Then really won on offering a high yield cash alternative to the traditional incumbent firms, and saw $40 billion of net deposits come in to their essentially cash management offering. So tremendous story there. They're now just adding mortgages. So they're adding these legs of stool, generally work with a higher, kind of like SoFi, a higher net worth customer on average. But it's been a great plan. I mean, 50% of their customers, more than that, come from referrals, which means like people love it. But it's really a it's I'd say less transactional model. Like, we want to grow very long term. We're not going to offer buying and selling of stocks, but we think we can give you a really low cost product to invest your money. We'll give you a ton of value on your cash. We'll give you one of the lowest priced mortgages in the market, and whatever else you want down the road, we're going to grow with you. And as your incomes grow, so their average age is 38, average income is 165,000. So working with people with kind of upwardly mobile, but I think it's very interesting because it's automate everything culture. But then on top of that, the stock is a little bit of the battleground is, hey, rates went up a lot, and that benefited the cash, money coming into their cash management account. So as rates come down, they lose all that money. And the data that I've seen is, they're over 20% of their customers now are using them for recurring. So essentially, people are moving money over regardless every month. So essentially, they're creating much more primary financial service behavior, primary bank behavior with their customers, which is SoFi's doing it too. All these firms want that primary bank relationship with these individuals that are coming over, because then once you have them in house, no more acquisition cost, and then you can deliver all these other products to them and give them a ton of value. But because it's all automated, actually do it profitably for yourself. So that's, I'd say, a little bit slower moving type of firm than a Robinhood, but I think culturally it's very, love the firm, very well run firm, kind of a little bit under the radar, just came public. So probably worth looking at as well in the same conversation of not quite as developed as a SoFi or Robinhood, but definitely I think has a vision to be a much broader platform.
Got it. Well, Devin, thank you so much. Really do appreciate it. Can I tell people to follow you on X?
Yes. Yeah,
well?
Please do. Yeah, I'm a newbie there, so just starting to post a little bit, but definitely, please do. And Tanner, we should do this again. Obviously, this is going to be, I think, an exciting year for the fintech ecosystem.
Yeah,
I think a lot of these elements that are on the come for the last couple of years, crypto being a big one, is like you're going to start to see it actually come in a more institutionalized way. So you're going to see more data points around that, and then firms like Robinhood and SoFi, I think, are just going to keep shipping products. And as we didn't talk about really AI. I mean, AI is going to accelerate the flywheels. Firms that know how to use AI and are going to lean into it. Robinhood's doing half of their code already with AI. Same thing with eToro. I'm not sure what SoFi's, but all these engineering cultured firms are using AI, and that's what that allows them to do, is actually get costs down even more per product. And so helps the unit economics story. And I think firms that are leveraging AI, we're going to wake up in 2 years and say, wow, they look really different, not in terms of what they're doing, but just they've really accelerated the roadmaps. Whereas firms that are not using AI to the same magnitude are not going to see the same type of growth. So you can really separate yourselves over the next 2 years here.
Well, thank you so much, Devin. Really do appreciate it.
Yeah, great seeing you, Tanner. Yeah, Be well.